guidelines. Your cameras and microphones have been disabled for the webinar, and you can send through some questions via the question and answer button on the toolbar. These will be addressed at the end of the presentations, obviously to save bandwidth. Also to point out that a recording of this webinar will be made available post the event. And please don't forget to book your one-on-one consultations with an individual financial consultant at Alexander Forbes to address your individual circumstances. Well, we are then ready to get going. Over the page. Just to look at the agenda for today's session. First of all, the welcome. We're doing that at the moment, and we're going to introduce you to the speakers just now. And these are the topics that would be covered. Background, differences between the different types of funds, comparison of benefits, and resources to help you, and a summary. These will be covered in more detail as we go along. Now for our speakers, over the page. Yes, thank you very much. Colleagues, presentations today will be made, first of all, by Dr. Sizwe Mabizela, the Rhodes University Vice-Chancellor, and then also Mr. Derek Munton from Alexander Forbes. He is very much involved with the funds. Alexander Forbes, as a company, of course, doing the administration of both the Rhodes University Pension Fund and the Provident Fund. Also on the slide, you see Gavin Keaton and myself. We are trustees of the pension fund, and we also serve on the project management team. We will be facilitating for today and also answer questions if we can. At this point, we would like to proceed with the first presentation over the page. And at this point, welcome Dr. Sizwe Mabizela. Great to have you on board. Over to you.
Thank you very much, Professor Nel. Good morning to all the attendees of this important town meeting. We all know that Rhodes University has two retirement schemes. The Rhodes University Pension Fund, which is a defined benefit scheme, and the Rhodes University Provident Fund, which is a defined contribution scheme. There will be detailed information in regard of these two schemes shortly. In 2018, actuarial analysis of the Rhodes University Pension Fund pointed to a significant risk that the fund placed on the university's balance sheet. Subsequent to that, an extensive exercise was undertaken whereby the trustees and the university reviewed the current benefit structure of the fund. Among other things, they considered the trends and developments in the retirement benefits industry, particularly over the past 2 to 3 decades, and the move away from defined benefit to defined contribution arrangements. The second consideration was in respect of the university's objectives to de-risk its balance sheet and support future financial sustainability of our university. So, after careful consideration, Council took a resolution that it was no longer practical to continue providing retirement benefits within the pension fund scheme, other than those that had already been accrued on this basis. Council also resolved to de-risk the university's balance sheet by restructuring the Rhodes University Defined Pension Fund Scheme and by consolidating the staff retirement fund arrangements that the university provides. And this will, of course, enhance the future financial sustainability of our university. As pointed out earlier, the Rhodes University Defined Benefit Pension Fund places an ever-increasing open-ended financial obligation on the Rhodes University resources. Will the university continue to sponsor, or to be a sponsor to cover the financial soundness, the soundness risk for members who decide to remain in the pension fund? Again, based on the current financial circumstances, Rhodes University can no longer underwrite the possible future funding shortfalls of the pension fund. So what that means then is that for those who would want to retain the fund will have to operate on a self-sustaining basis, on a self-funding basis going forward. The arrangements are that the fund will establish an expense reserve account. And in the event that the fund finds itself in a deficit in future, the university will not be able to make any contribution. So in that regard, it is possible that the fund trustees may decide, among other things, to reduce the benefits that are provided to the pensioners. We acknowledge that this is an emotive issue. It is a sensitive issue and should therefore be handled with due care and with necessary sensitivity. We acknowledge members' anxieties and that this issue is not just complex, and it can also be quite unsettling. Throughout the work done to date, we have been very clear that to the extent possible, this process has to be undertaken in a manner that leads to a satisfactory outcome for our current members of the pension fund, for the retirees, as well as for the university. So over the next couple of months, the project team working with the university management and the trustees of the fund will be providing members with every opportunity to come to a full understanding of the issues so that they can make good, sound, and informed decisions about their retirement savings. I thank you.
Thank you very much, Dr. Mabizela. That was very informative. We do appreciate your time. Colleagues, we move on with the webinar from here. And our next speaker is Professor Gavin Keaton, who is going to take a closer look at the different types of funds. Over to Gavin.
Thanks, Hugo, and good morning, everyone. As Hugo says, I'm going to look at the differences between defined benefit and defined contribution fund and how we will fit into these two funds in the future. So as the VC said, at the moment, Rhodes has two funds, the defined benefit fund, which we all belong to, and then the defined contribution fund, which we'll be joining from the 1st of April next year. The difference between these two funds is really in their name. In the defined benefit fund, it's the benefit that's defined. In the defined contribution, it's the contribution that's it's the contribution that's defined. Within a defined benefit fund, the retirement benefit that you're going to get depends on your years of service, years of completed service, as well as your final pensionable salary in the last 12 months of your employment. And for this fund, the employer shares in the risks and rewards of the fund's investment. In the defined contribution fund, you as a member will have a retirement benefit that depends on how much what was contributed by the employer and yourself to the fund, as well as the investment performance of the fund. So you share it directly in the risks and the potential rewards of your investment portfolios that are offered under the defined contribution Rhodes University Provident Fund. Let's compare the benefits under these two different forms of funds. Starting first with the contributions. And the pension fund at the moment, we pay 7.5% of pensionable salary into the fund, and the employer, Rhodes, pays the balance of the cost to provide the members with the promised benefit after our contribution has been taken into account. That employer contribution at the moment is currently 15% of pensionable salary, less costs of administering the fund. Now, from the 1st of April 2022, all current members will be, active members will be shifting to the Provident Fund, so there'll be no further contributions paid by either the employer or the members into the pension fund. We will shift to the left-hand column here, where our member contribution will remain 7.5% of pensionable salary, and the employer will contribute 15% of pensionable salary, less costs, into the Provident Fund. What are the retirement benefits? Now, remember, you may choose to leave your current pension fund money in the pension fund, and so you will be able to continue to get benefits from what you have accrued to date from the pension fund, and then all future contributions will be going into the Provident Fund, and so you'll be getting benefits from the Provident Fund as well. Or you may choose to shift your actuarial reserve from the pension fund into the Provident Fund, then all your benefits will just be in the Provident Fund. But let's look at what those are. That in the pension fund, benefits at retirement are based on a fixed formula that is laid down in the rules of the fund. Now, the key within that is your pensionable service, your years of service, and that will be calculated as service up until April 2022. And on retirement, if you leave your funds in the pension fund, you'll receive a pension calculated by using the fixed formula included in the rules of the fund. So that will be your pensionable service multiplied by 2.7% and your final salary. And you can at any time choose to retire early from the fund. Now, under the Provident Fund, retirement benefits are determined by the contributions you and the employer make to the fund, less costs, plus the investment returns during the period of membership of the Provident Fund. On retirement, you've got to convert at least 2/3 of your fund balance into an annuity or pension, which you must buy from a registered insurer outside the fund, say Old Mutual or Sanlam. And you could choose to retire early from the Provident Fund as well. Death benefits. In terms of the pension fund, if a member died, the member's estate would receive a lump sum of 2 times your annual salary, plus a spouse's pension equal to 40% of your pensionable salary at death, and a child's pension equal to 10% of pensionable salary at date of death per child for a maximum of 3 children. And children's pensions doubled if there was no spouse. If there was no eligible spouse or children, then the estate would receive a lump sum equal to 2 times your annual salary, plus a minimum of accumulated contributions, plus any additional transfers that you had paid into the fund. So that was under the pension fund, but if we now look at the provident fund on the left, the death benefits there are lump sum equal to 4 times your annual pensionable salary, plus the credit that you have accrued within the fund. Now that credit could include your current actuarial reserve in the pension fund if you've transferred that across to the provident fund, or that actuarial reserve may still be sitting in the pension fund, in which case it would also be part of your death benefits. Disability benefits are unchanged. They're exactly the same under the pension fund and under the provident fund, and that is if you are disabled and forced to stop working, you will receive a pension equal to 75% of your monthly pensionable salary. Withdrawal benefits, these apply to somebody who leaves Rhodes, goes to work somewhere else, or maybe is retrenched or is fired. Now, it's a very complicated formula under the pension fund, but I'll just go through that. If you withdrew from the fund, from the pension fund, you're entitled to your accumulated contributions plus an additional 0.5% of your accumulated contributions for each month of membership, subject to maximum 100%, as well as the transfer value, if applicable, from the AIPF. If you elect to preserve your benefit, you'll be entitled to the cash withdrawal benefit plus an additional amount equal to 10% of the difference between the cash withdrawal benefit and the actuarial reserve value for each year in excess of 5 years, subject to 100%. Now, as I say, a very complicated formula, but all of this was still controlled under the Pension Fund Act, which required that the final benefits, if you withdrew, could not be less than the member's individual minimum individual reserve. So that was actually laid down by the Pension Funds Act and not just the rules of the fund. So now in the Provident Fund, if you withdraw, you will receive your full fund credit if you leave the fund. And as I said, if you left your actual reserve in the pension fund, you would be able to withdraw that as well. And if you transferred it to the Provident Fund, it would obviously be part of your full fund credit. So Derek Munson from Alexander Forbes is now going to take us through how the changes to the fund will actually be implemented in the new year. Derek, you're muted.
Thank you very much, Gavin. Much appreciated. And thank you to everybody for giving us the privilege of presenting to you today. So let's look at the changes to your fund from 1 April 2022. So from 1 April 2022, your future contributions will be paid into the Rhodes University Provident Fund. You then have the choice of either leaving your actuarial reserve value in the pension fund as a paid-up defined benefit pension benefit, or voluntarily transferring your actuarial reserve value to the Rhodes University Provident Fund, where you will then be able to invest it in accordance with your specific needs. So how will this be done? From 1 April, you'll join the Rhodes University Provident Fund, and your future contributions will be paid into the Provident Fund. You'll also be covered for death and disability benefits under the Provident Fund, as your death and disability cover will cease on the pension fund from 1 April 2022. Gavin did touch on these points a bit earlier. You would have all received a conversion statement as at 1 October. This provides you with an illustrative value and will help you with your decision. It's very important that you do engage with an accredited financial advisor with regard to your decision, as everyone's circumstances are different. Please note that your conversion value will be recalculated on the actual effective conversion date of 1 April 2022, taking into account your salary, pensionable service, and your accumulated member contributions up to 1 April 2022. We'll talk about the support that Alexander Forbes can offer you in the next couple of slides. In terms of your choice, you've been provided with an option form. This was provided in the communication pack recently sent to you. Please make your choice of either transferring your actuarial reserve value to the Provident Fund or whether you'd like to retain your benefit in the pension fund. This form must be provided to your Human Resources Division by the 15th of March 2022. There is support in helping you make your decision, and we encourage every member to meet with an individual financial planner to assist you with your decision to either move your actuarial reserve value to the Provident Fund or to retain your benefit in the pension fund. Alexander Forbes have made individual financial planners available to you. Invitations for one-on-one consultations were distributed via email on the 19th of October. Please click on the link provided in the electronic invite to book your session. Please also make sure that you have your provisional transfer statement as at 1 October 2021 with you so that you can engage with the financial advisor on a one-on-one basis. On the slide, we've included the screenshots or mugshots of the individual financial planners that will be available. On the top left-hand side, many of you will be familiar with Roy Morgan, who's a senior financial advisor, who has a wealth of experience and is the dedicated financial advisor allocated to the Rhodes University retirement funds. To support Roy, on Roy's right is Buntu Bam, followed by Greg Bradfield, Don Ridden, and bottom left, Brent Kops and Alushka Anderson. Bottom right is Rob Rayner. He's the head of our individual financial planning division within Alexander Forbes and has been responsible for coordinating the individual advice platform. Importantly, we will also be hosting a webinar to tell you more about the Rhodes University Provident Fund. This will be held on the 18th of November 2021. Please look out for the invite, which will be distributed early in November, and please make every effort to attend. The session will be recorded and posted on the website for those of you who cannot attend. This session will give you valuable insights into your investment and savings options, as well as online financial planning tools available to you. Everything that you need to know about the restructure, as well as the pension fund rules and the event information, has been loaded on the Rhodes University Pension Fund Restructuring Information site. The website is www.rupensionfund.co.za and appears on your screen. As mentioned earlier, this town hall session we're having today is first of several events between now and April 2022. So just looking at the upcoming events, we have the information session on the Rhodes University Provident Fund, and then an investment planning, retirement planning, and savings option information session as well. This will be followed by a wills and nomination of beneficiary forms event on the 18th of May 2022. And we really do encourage members to participate in these sessions, as there will be the invaluable information gleaned from these sessions. So in summary, we'll play a 9-minute video taking you through the changes. Please also bear in mind that we understand that there are complex issues to unpack, and the project team, the university, and the pension fund trustees will be providing you with every opportunity to come to a full understanding of all the issues so that you can make an informed decision about your retirement planning into the future. The uploading of this video will take a little bit of time, so please be patient with us. I'd also like to ask that you turn your volumes up, as the sound might come across a little soft. So do crank your volumes up while we start the video up. Thank you.
Hi, Sally and Sia. So glad you could make it. I'm a consultant from Alexander Forbes, the administrator of your pension fund.
Hi, Amanda. Sorry for being late. I was reading the letter sent to us by the Rhodes University Pension Fund. I'm an active member and not sure what the restructuring of the pension fund means.
That's what I'm here for, Sally. Let me explain it to you.
Amanda, I'm afraid I don't understand the restructuring either. I've been telling Sally that this has come at a time when we are already dealing with so many challenges, especially COVID-19. As a pensioner, it makes me nervous.
Okay, let's start at the beginning. From the 1st of April 2022, all active members will join the Rhodes University Provident Fund. Your contributions, along with the university's contributions, will continue being allocated to the Rhodes University Pension Fund defined benefit structure until the 31st of March 2022. With effect from the 1st of April 2022, your contributions, along with the universities, will be allocated to the Rhodes University Provident Fund defined contribution structure. The level of contributions that will be paid to the Rhodes University Provident Fund will be the same as what was being paid to the Rhodes University Pension Fund. Please note that even if you have elected to transfer your accumulated pension fund value, as at the 1st of April 2022, to the Rhodes University Provident Fund, your value will remain invested in the Rhodes University Pension Fund and will continue to accumulate with investment returns until such time as the Financial Sector Conduct Authority approves the transfer, which will be sometime after the 1st of April 2022. Sally, as an active member, you need to decide whether you want to leave your total savings up to the 31st of March 2022 in the defined benefit Rhodes University Pension Fund, or transfer your total savings up to the 31st of March 2022 to the defined contribution Rhodes University Provident Fund. Sia, as a pensioner, you need to decide whether you want to leave your pension in the defined benefit Rhodes Pension Fund without any changes, or buy a different pension or annuity using the current value of your savings in the defined benefit Rhodes Pension Fund. Sally, from the 1st of April 2022, all your contributions to retirement will be paid to the defined contribution Rhodes University Provident Fund. You'll also be insured for death and monthly disability income benefits under the Rhodes University Provident Fund. This means that if you resign, get retrenched or dismissed, or pass away, either you or your beneficiaries will benefit from either the Provident Fund or the Provident and Pension Fund, depending on your choice.
May I ask, why is Rhodes restructuring the pension fund?
Well, firstly, to consolidate the staff retirement fund arrangements, and secondly, to support the future financial sustainability of Rhodes University. A defined benefit structure promises to pay you a certain amount calculated using assumptions. The fund can't accurately calculate these future amounts because we don't know what tomorrow will bring. And that presents the university with a financial risk. This restructuring will remove this financial risk.
Thanks for such a thorough explanation. That said, is this in my best interest?
Everybody's personal financial circumstances are different, but the changes certainly can have some advantages of a higher pension at retirement than you would have received from a defined benefit retirement fund due to better investment performance. If you change employment, you'll be entitled to take the full benefit. You also have a wider choice of investments to choose from.
Amanda, are our funds in the Rhodes University Pension Fund still safe?
The Council ruled in 2020 that the university could not afford to make further additional contributions to the pension fund. The university needed a long-term solution to address possible future funding problems of the pension fund. The university must meet its commitments to all its stakeholders equally. In an environment of fiscal austerity, it cannot continue to favour a defined pension fund that has fallen out of favour with local and global trends. The university is saying if the fund gets into a deficit in the future, it will not be in a position to bail out the defined benefit Rhodes University Pension Fund.
When can we expect more information and dates for our presentations and consultations?
You'll be pleased to know that the presentations for active members will take place in October 2021 and for pensioners in November 2021. We'll also thereafter kickstart the individual financial planner consultations with members and pensioners to explain the different investment options available. More information on the restructuring is also available on the Rhodes website. Let's look at the timelines. Active members need to check your statement in October. You'll get a statement with the predicted value of your retirement savings as of October 2021. This will guide you as to approximately how much will be credited to the Provident Fund if you choose to convert and transfer this benefit to the defined contribution Rhodes University Provident Fund. Attend a presentation. The Fund's consultant and the Human Resources Department will host presentations in October 2021. Please attend these presentations to understand how the restructuring will affect you. Submit your choice by emailing your signed option form to your HR division. Whatever your choice about your existing funds, all active members will join the Defined Contribution Fund on the 1st of April 2022. Pensioners need to talk with a financial planner. A financial planner will contact you to discuss your current pension position and future provision and planning. Complete the option form and submit this to consult with Alexander Forbes at aforbes.com should you want to explore the option of purchasing a pension outside of the fund. This option form will enable the actuary to calculate the value of your actuarial reserve and will enable your financial planner to obtain pension quotations. Make your decision by the 30th of June 2022.
If I choose to transfer, how long will the transfer of the funds take?
Once the election process is completed, the transfer of members' fund values could take 6 to 8 months because this process is governed by Section 14 of the Pension Funds Act. A Section 14 transfer has complicated reporting requirements, which must be finalized before the Financial Sector Conduct Authority will approve the transfer of money to the Defined Contribution Rhodes University Provident Fund.
Amanda, thank you for sharing this important information with us. I now feel comfortable that Rhodes University and the trustees of the pension fund are ensuring our money is safeguarded. I feel much better after talking to you.
It's a new dawn for Rhodes University Pension Fund active members and pensioners.
Back to me, Hugo, everyone. Thank you very much to both Gavin and Derek for your presentations. I can see a lot of questions coming your way already. Folks, we are approaching the end of the session now. This is just to indicate how you can get in touch in order to discuss further. Call on 0860 talk to AF or email consult@alexanderforbes.com. Over the page. In the last section, which will be the facilitation of question and answers raised in the webinar chat, facilitated by Gavin and myself, just to remind you that the recording of the webinar will be made available and accessible on the Rhodes University Pension Fund restructuring site. We will now facilitate the question and answer session raised in the chat facility. Of course, just to point out that if time runs out, the question and answers will be made available on the Rhodes University Pension Fund restructuring information site. So At that point, thanks again to everyone making a contribution so far. And folks, we now go into the question and answer session. Over to you.
Okay, thanks, Hugo. So I thought we'd just start at the top and see how many of the questions we can get through. We've got until 11, and as Hugo said, if we can't answer everything, we will put the Q&As onto the website. So the first question from Prof. Mutambara was, could the trustees reduce the benefits to zero? And the answer to that is no. Benefits may not be reduced in a pension fund, but what could be zero is the future increases in pensions. And then she says there's no indication whether the employer would continue to pay 15% of pensionable salary less costs into the Provident Fund. I think she's referring to the letter you received. The answer to that is yes, the employer will pay 15% less costs of our salary into the Provident Fund. The next question from Prof. Bunting, it says the fixed formula at number at April 2022 is then frozen in time and does not get adjusted for inflation between 2022 and your eventual retirement date. Derek, could you answer that question, please?
Certainly. So if we can just repeat that, I actually want to pick that question up in the. Is it
so
from?
It's about the third of the actual questions from, it says Mark Bunting. It says the fixed formula number at April 2022 is then frozen in time and does not get adjusted for inflation between 2022 and your eventual retirement date.
Yeah, so on that point, Mark, so what happens is that the things that remain constant is your years of service to April 2022. However, your final average salary will be adjusted with your salary increases that are applied on a yearly basis. So that is factored into your formula. So the variable component is your final average salary. So it will take account of inflation indirectly through your salary increases.
Thanks, Derek. Then from Trevor Amos, he says, why is remaining within this restructured defined benefit fund even an option? And Trevor, I think the answer to that is, speaking from the discussions by the trustees, is that we wanted to give members a choice. And which they choose is very much dependent on their individual financial circumstances, which might be how long they've been in the fund, how long they've got to retirement, what alternative retirement options, funds they have. So the trustees thought the best way was to give people a choice to either make a complete break and move to the Provident Fund, or to keep their existing benefits within the pension fund. Then George Wells says, what other options were considered other than closing the pension fund? For example, extending the retirement age, increasing joint contributions. And George, again, the trustees went through an extensive analysis of that with the actuary, all the various options. And this was deemed, the way we're going was deemed to be the best way forward. But I just want to point out the pension fund is not closing. The pension fund continues to exist. It is just that no further contributions will be made to the pension fund. So there will still be pensioners, and there will still active members are entitled to leave their current funds and benefits in the pension fund if they choose. Then another question from Prof. Mutambara says, it says it's in the Provident Fund, you carry the risk of poor investment performance. Does that mean that it's possible for one to lose all your contributions due to poor investment performance, that you would end up with zero benefits? Well, I guess the answer to that is it is possible if the stock market completely collapsed and government reneged on all its debts or whatever. But the whole point of having professional fund managers is to try and protect one as much as as is possible against poor investment performance. And then Prof. Mutambara also asked what would have happened for the pension fund to find itself in an underfunded position. Well, that's really, as Dr. Mabazela said, that's what started this whole process, that the university has told us that it is no longer in current financial circumstances, it would not be able to meet such a shortfall, and the trustees would then have to react by adjusting the benefits available to members, which would have to mean either zero pension increases going forward, or in an extreme case, it would have to mean a closing of the fund. Then Lindy says she never received a conversion statement. When were those sent out? They were sent out a few weeks ago, so we'll check as to why you never got your benefit. Derek, I think if you could answer this next question from George. He says, are the transfer values equivalent to what would have been earned in the Provident Fund?
Yeah, so that's a very tricky one, George. So the only way we could do that is actually do a parallel calculation. The transfer values clearly are calculated based on your years of service. It's a formularized benefit based on your years of service, your final average salary, and of course the accrual rate of 2.7%. So it's not a direct comparison, but one could in effect do a simulation had you been in the Provident Fund and rolled that up to see what the outcome would be. But that would be a separate exercise altogether.
And then, Derek, the next question from Mark, I don't know if you can see it, it's a tax question. Is the transition completely tax neutral?
Correct. It's completely tax neutral with the Income Tax Amendment Act provisions coming into play on 1st of March 2021. So the pension fund benefits move across tax-free into the Provident Fund.
Okay. And then another one from Prof. Mutambara. What is the difference between leave your actuarial reserve value in the Rhodes University Pension Fund and remain in the Rhodes University Pension Fund? Derek, again, could you help there?
That's kind of one and the same question, in that your actuarial reserve value, if you leave it in the pension fund, your benefits will still be determined in accordance with that defined benefit formula. And as I indicated, the only constant will be the years of service, but your pensionable salary will obviously vary in accordance with salary increases that are granted. So in effect, you'll have a paid up defined benefit, pension benefit in the pension fund. Whereas if you elect to uplift it, that's the present value of your pension benefits accrued at that date. That capital will then go into the Provident Fund if you so elect to, and then you will have the opportunity of then investing that in accordance with the underlying portfolios that are on offer within the Provident Fund. I hope that answers the question.
Thanks, Derek. The next one, I think, also for you, or maybe we'll have to ask the actuary. How will the final conversion value be calculated? And
Gavin, I think you've frozen there. Can everyone hear me? Nikki?
Yes, Derek. The question is, how will the final conversion value be calculated and what could affect it? What role will the discount rate play? How volatile is the rate?
So the eventual benefit will be based on, so between now, October, and 1st of April, your contributions and your service to that point, as well as any salary adjustments, will be taken into account. So we would see that the benefit would be slightly bigger. When the actuary does the calculation as well, it will be the discount rate that was applied as at the valuation. and that discount rate that we speak about is an index-linked inflation bond yield, so it is pretty stable and is published by the FSCA's website. So it's certainly not an index that's linked to an aggressive balanced equity portfolio. So I do not foresee any volatility in that discount rate in calculating your final transfer value.
Thanks, Derek. The next question, members want to know who sent out the email for the financial planner link, and I think somebody answered that later in the chat. It was Siam Mohammed, but for those of you who can't find it, you are more than welcome to send me an email. You all have my email address, Nikki Kajitsa. I will just post it on the chat for you as well.
I'm just standing in here for Gavin. Maybe he has lost the connection for a moment. The next question, and this is also for Derek, please. Can you supply the discount rate history over the last 10 years, and why has it changed this year? That is from Mark Bunting.
Certainly, we could provide a history of that. And as I indicated previously, that discount rate is linked to that inflation-linked bond yield. And it did change. And as such, that is why they actually factored that into the calculations for the conversion values as at 1 October.
Thank you very much, Derek. We're moving on to the next question from Letitia. The question is, why is there not a third option to take our investments elsewhere? Why only funds stay with pension or move funds to the Provident Fund, in inverted commas? Alexander Forbes doesn't seem to offer the sufficient returns on any of their investments offered to us, the Rhodes staff. This poor performance is therefore the question. Derek, would you also deal with that one, please?
Yeah, I have to say I beg to differ. We can compare those returns with what we provide the trustees with is surveys, global surveys on competitor investment managers, and we stack those up so that the trustees at all times are able to make comparatives. One must also remember that you can't compare pension fund returns or provident fund returns with individual shares or retail type investment arrangements in the marketplace, because Regulation 28 governs the asset classes and the proportions in which pension funds and provident funds can invest. So we're quite happy to share with you the investment returns achieved by the various portfolios within the Provident Fund. And the trustees continuously review those underlying portfolios, and where appropriate and necessary, will add alternative managers onto that platform. So more than happy to share with you and provide you further information on how those portfolios have actually performed relative to various indices as well as competitor portfolios. Thank you.
Thank you, Derek. We have another question from Professor Mutambara. The question is, when leave actuarial reserve value in the Rhodes University Pension Fund as a paid-up member, does that actuarial reserve value earn interest while it is in there? Derek, over to you, please.
So being a defined benefit fund, your reserve value and your benefits there will be determined by your salary increases. So that's the variable. So as your years of service will be a constant, it will be your years of service up to 1 April 2022, multiplied by the 2.7% accrual factor, and then multiplied by your final salary in the 12 months preceding retirement. So your salary increases will be taken into account in determining what your eventual benefit will be in the pension fund.
Thank you, Derek. Professor Mutambara still has the floor with another question. What caused the shortfalls which necessitated Rhodes University to pay an additional 10 million in 2019 and 47.52 million in 2020 into the Rhodes University Pension Fund? Derek, would you help us here?
Yeah, so the university has always applied the principles of equity. So they've kept the employer contribution rate of 15% equal across the various retirement fund arrangements. Now, typically with a defined benefit fund, we find that with the actuarial assumptions going forward, mortality rates changing, longevity risks, etc., the actuary has to make certain assumptions about these aspects changing going forward. And measured against that is obviously the fund's investment performance. The fund has done very well out of its two balanced fund portfolios, FOOT and Investec. However, as we all know, that there was a period when global markets and local markets took a pounding with COVID and the like, and that in turn had an impact because the investment returns earned did not cover the underlying assumptions applied to the liabilities.
Thank you, Derek. Professor Mutambara, we hope that answers your question. We've got another one from Trevor Amos. What factors influence the decision to leave or transfer to Provident?
Sorry,
you have the floor. Can I repeat that, Derek?
Please, if you wouldn't mind.
What factors influence the decision to leave or transfer to Provident? That's from Trevor Amos.
Well, the university has funds on offer, or they prescribe various funds that are available to their employees. And the university felt that it was appropriate that the existing structure that was in place was the best vehicle within which to consolidate their retirement funds on offer, but at the same time not to unilaterally just simply shut down the Rhodes University Defined Benefit Pension Fund, but to give members the opportunity to consolidate, if they wanted to, transfer their benefits across to the Rhodes University Provident Fund. Obviously, also in rationalizing and consolidating retirement benefits, economies of scale come into play. So the more members you've got, the more assets you've got under administration, the better the trustees are able to negotiate administration fees, investment fees, reinsurance, death and disability premiums as well. So it is a win-win for both pension fund members and Provident Fund members within the Provident Fund, in that great economies of scale gives a greater buying power with those various elements that I spoke about.
Okay, thank you, Derek. Gavin, I see your connection has been restored. Would you like to facilitate a few?
Sure. Apologies to everyone. My internet stopped, so I'm now via my telephone, so hopefully the link holds. The next question was, were other fund managers considered by Rhodes taking into account the history of performance and costs? If so, can this information be made available to pension fund members? Well, as a trustee, I can tell you, yes, they were. And just first a reminder, it's not Rhodes who invests the funds. The pension fund is run by the trustees, half of whom are elected by members and half of whom are elected by the employer. And so every pension fund meeting, we go through some very big charts that compares the asset managers that we employ, compares their performance with their peer groups. The two fund managers who manage the assets of the fund are Ford and 91, previously Investec. And we believe their performance has been acceptable over a long period of time, and that performance is actually available. You can get it, I think, on Business Day, the Financial Mail. You can compare these asset managers to other asset managers, and I think you will see that that they are good professional managers. Derek, any comments there?
Quite happy that you covered those points, Gavin. Thank you.
Sure. Okay. Letitia says it's incorrect to say that the risk has been removed. It simply moved from Rhodes University to the staff. I don't think the video did say the risk has been removed, but I stand to be corrected. And the risk hasn't been removed from Rhodes because there are still going to be members remaining in the pension fund. And it is true that in the Provident Fund, members have to take risk of poor returns, but members do also have the potential of good returns if investment performance is good.
Thank you. Gavin, just to add to that particular answer, I think Letitia is posing a good question and you've answered it well. Just to add that once in the Provident Fund, members have the option to select a particular investment portfolio, which is matching their particular goals, their particular lifestyle, and these investment portfolios are designed to manage the risk outcome. That is something which is not available in the pension fund. So just to emphasize that there is an element of risk in the Provident Fund, but that risk can also produce a very positive outcome for members. Thank you.
Yeah, and I mean, perhaps also on that, just remember that a lot of our colleagues are already members of the Provident Fund. They chose that as their preferred means of saving for retirement. What's next? I didn't understand from the video that you can choose to invest their contributions in the pension fund into annuity within the pension fund. I think that's a misunderstanding, Prof. Mutambara. So what you can do is to leave your current funds in the pension fund if that's what you wish, or you can move them across to the Provident Fund where you would choose which of the portfolios Hugo was speaking about, where you wanted to invest it. Then there's a very technical question from Kevin Maria. And Kevin, I'm not trying to duck the answer. I just think it's a very complicated one about the discount rates. And so I think it will be best for us to get the actuary to reply to you on that. And I promise we will do that, and we'll put the answer up on the Q&A as well. But you're talking about the discount rate fluctuating. Well, you know, just as the economist in me will say to you, well, in fact, government bond rates have increased significantly in recent times because of the rising debt and downgrade of our government debt to junk. So there have actually been large increases in government bond rates, but how that translates into the discount rate, the actuary will have to tell you. I'm afraid we're drawing at the end of our time, but let's just take a few last ones. It says, how many Alexander Forbes funds will we be able to choose from? At the moment, it is only 8. What if I wanted to put a large proportion of my funds into emerging markets subject to Regulation 28? This option doesn't seem to be available. Will you be giving more options? Hugo, perhaps you can help from the point of view of the Provident Fund and how many funds are offered?
Yes, the portfolios we offer at the moment have been designed to represent a fair amount of choice in terms of different needs. And sorry, something in my throat, particularly covering the life stage model. The one portfolio which has proven to produce very good returns over the long term has been the performance portfolio. And that has incorporated a more balanced approach as compared to the specialist range. But in terms of your question on the emerging side of the economy, I think maybe Derek can add to the answer here.
Thanks, Hugo. So obviously and as you correctly pointed out, you restricted and you governed by Regulation 28. So the underlying portfolio managers will allocate as much as they can and as much as they deem appropriate to emerging markets as they feel that would add value in that portfolio. And as Hugo alluded to, the fact that the trustees do regularly review those. So we went through a investments workshop recently where there was a decision to bring some more portfolios onto the platform. So as and when the need arises, and based on feedback from members, the trustees do take into account their needs and requirements to add additional portfolios onto the platform. Thank you.
Okay, then Lindy says this is totally overwhelming. I do not have financial acumen regarding the value and discount rates, etc. And Lindy, this is precisely why we say that members must meet with a financial advisor to seek professional advice as to what their best way forward is. And we really urge that. It's not something for you to do on your own. And we have links to Alexander Forbes, but if you have your own financial advisor already, you're welcome to use that advisor as well to suggest to you what the best way forward is. Letitia is unhappy that people have to type their queries. I'm afraid this is the way all webinars I've been involved in work, but perhaps we can look at some alternative in the future. I think this question from Chris is really what Derek referred to it previously, to say, has anybody compared with the value of our funds would be had we invested in the Provident Fund from the start versus what we have accrued in the pension fund? And I think that depends very much on when you joined the pension fund and when you would have joined the Provident Fund. Derek, is that correct?
Yeah, that's correct. So it's very difficult. So if you had higher salary increases, the probability of you having a higher benefit than somebody in the Provident Fund. It's also the timing of those investments and the time horizon that you look at. So it is difficult to just give a blanket answer, but we could certainly do a simulation to see, you know, had you been in the Provident Fund based on current salary, based on the contributions, one could in fact do a parallel calculation, but that would be an individualized calculation requiring the input of the actuary.
Yeah, and of course we also don't know what the situation would be going forward.
Yeah.
Then I'm afraid I was offline when there was the thing about the third option. I see Desiree says Derek didn't answer the question, why no third option? Well, in the webinar, the entire webinar the other day, the lawyer there, the pension fund lawyer, did say that you could only join a fund that was in which your employer currently participates. There's never the option of going outside of those funds. Now, I don't know if Rhodes participates in any more than the pension fund and the Provident Fund. I don't know if any of the other people, Derek, do you know, or any Hugo?
I know that there is an NBC umbrella fund. I'm not sure if it's still in existence, but that is my understanding. But obviously, the university took into account the cost structures and the arrangements that would give the most optimal benefits for members of the pension fund and the Provident Fund. So research was done in that regard, and also there were some queries about members transferring to retirement annuities, and the trustees were clearly of the view there that it wouldn't be in the members' best interest because of the high cost structures associated with a retail product such as a retirement annuity, let alone the lock-ins that they have as well. And in order to benefit from economies of scale and to make sure that you are getting competitive risk rates and administration fees and investment fees, and the university and the trustees were very cognizant of the fact that it was best to keep the members consolidated in a fund prescribed by the employer, such as the Rhodes University Provident Fund. Thank you.
Okay, the next one from Trevor says, assume one decides to uplift and transfer to the Provident Fund. On date of retirement, how will years of service be determined? Will it be calculated as from date of employment or date of joining Provident Fund? Years of service will no longer be relevant if you uplift and transfer to the Provident Fund. Because it's simply the amount of funds that you've got in the Provident Fund. So maybe the question refers to if you actually don't uplift, because then it will be your years of service up until the 1st of April 2022 that will determine what is the value of what you left in the pension fund. Next one is, should I decide to leave the funds in the pension fund, does that mean those exact funds will stay the same upon retirement as they are at risk or affected by the economy? I think you, Derek, you answered this through a different avenue previously as to how the funds would be affected by salary increases.
Correct. Yeah.
So the funds would increase in line with your final salary.
Yeah.
What factors influence the decision to leave or transfer to Provident? Again, I think it's very much personal circumstances, and that's what one needs to discuss with your financial advisor. Are active members allowed to leave the pension fund before April 2022? I jump ship and start soon on the Provident Fund. The answer there is no, because we need the rule amendments that have been that have to be approved by the regulator. I'm correct there, am I, Derek?
Correct.
Okay. The last question is still about the discount rate, which I've been avoiding because it's something I don't profess to understand myself. Derek, I don't know if you want to try to address it, or do we leave this for the actuary? It says, why the huge change in the discount rate this year?
Yeah, so it is the discount rate that is the most significant factor causing the benefit to only increase modestly over that period in question. And that discount rate increased from 3.31% to 4.36%. And obviously, that has a material factor on the present value. So obviously, the higher the discount rate, the lower the present value. And that's what impacted that. And those discount rates, which are linked to the index-linked inflation bond yields on the FSCA website, they're there. And I think you've alluded to, from an economic perspective, why those bond yields changed over that period. And this is where it has impacted on the present value of the actuarial reserve values.
Trevor again saying, irrespective of personal circumstances, what sense does it make to remain within the pension fund? As I said, look, Trevor, we're not allowed to give personal financial advice. You've got to be a financial planner to do that. I don't know if there's anything, Hugo, Derek, you could say other than personal circumstances.
Correct. I mean, there's a multitude of personal circumstances that would dictate to that. External assets that members might have, difference in the age gap between members and their spouses. There's a whole host of elements that will go into a holistic financial planning process.
Thanks. Okay, it seems current pensioners within defined benefit stand the risk of losing heavily over time in breach of the employment promise made to them. Long-serving active members risk loss if retiring in the next few years, given a lack of time to make good on Provident Fund performance. Well, part of the answer to that question, I think, is that you don't have to move. You can leave your funds in the pension fund if you believe that is what best meets your personal circumstances.
Yeah.
Derek?
Yeah, happy with that.
Happy with that. And then Edward says, not happy about the answer that Signia offers huge choices that are still regulation 28 compliant, removes a lot of choice. So, well, I guess that's a question for the trustees of the Provident Fund to think about as to whether they wish to offer a greater choice to members.
Which they can do.
Hugo, you agree with
Yes,
that?
Yes, just to add to that, the investment choice available in the Provident Fund is, of course, running according to a multi-manager approach. So the best of various investment firms have been incorporated in the whole decision-making process when it comes to managing the investments. And from that process, the range of portfolios available at the moment have been chosen. But this is, of course, a process that evolves all the time. New suggestions, new opportunities that may come up can be made available to members as well.
Okay, well, that's the end of the questions. I know we haven't fully answered the question about the discount rates. I mean, I think Derek
Yeah. Gavin, you broke up there.
So we've got quite a bit over time. When can we expect a response to the request for one-on-one meetings? I sent in a request earlier, no response. Derek or Nikki, I don't know if you can answer that.
Yes, Gavin, thanks. The financial planners will contact you in the next day or two to start setting up the one-on-one appointments.
Okay. Well, thanks to everybody for joining. Thanks to Dr. Mabazela for joining us and briefing us on the university's position. Thank you all to participate. As Dr. Mabazela said, we are fully aware that this is very difficult and sensitive stuff, and we hope that we have gone some way to providing greater understanding. But we again want to just urge that members seek that individual advice from a financial planner as to what their best options should be. Anything more from you, Derek?
All good from our side, and just to thank the members for participating in the session, and thanks to the panel. Thank you.
Dr. Mabazela, I don't know if you want to say anything.
No, Kevin, just to thank you and to thank the team, but more important, to thank all those who have attended and have really asked some important questions, and just to advise them that it would really help to approach a financial advisor to make the best decision. Thank you.
Gavin, also just from my side, to say a word of thanks to everyone. To the presenters, also to Dr. Mabizela for starting us off today. Thank you for the questions. We found that highly interactive and very interesting, some of them technical, and you will be getting answers on those. Just to assure everyone that the whole process that is now underway is an extremely structured and well-managed one. There are various groupings involved here. There is a council, a task team consisting of external experts, legal, actuarial, financial. Rhodes has its own project team, as we see here today, and then, of course, the trustees. So the approach being followed in this is to move forward in the most productive way. Thank you also to the members. And please feel free to continue sending in your questions and then until the next session. Thank you from my side.
Well, thank you to everyone. Bye.
Bye, everyone.